Earnings this week, another thing for us to keep in mind. Phil Palumbo joins us. Tom White here in studio. Phil's President and Chief Investment Officer at Palumbo Wealth Management. Tom, of course, host of Fast Market. Phil, welcome back. Thanks for being here this morning. Tell me what's on your mind for banks as we kick off earnings season.
Yeah, thanks for having me. So, I'm very bullish on the banks overall, and a couple of key reasons. For us, we really believe that the deregulation that we're going to see, we're seeing rates move higher, especially on the long end. All that will improve net interest margin for a lot of these banks, which have been waiting for a very long time. As we see the economy continue to strengthen, and I believe will continue to strengthen over the next couple of 3 years, that'll really bode well for merger and acquisitions. So that really will help some of the larger, more dominant banks. And then overall, just again, the JPMorgan, which is a big investment of ours that we continue to believe in as the most dominant bank out there. We think Jamie Dimon, really does a great job in PR and dominating really all over the world. With the asset management businesses improving and wealth management improving, specifically in the emerging market areas, we continue to think that JPMorgan and some of the other large banks will continue to profit.
All right. How much of it is interest rate dependent? Do they need to get a favorable curve, or is the point for JP Morgan that they thrive when other banks struggle?
I just think overall, as you're seeing the long end move higher and you're starting to see now a difference between the long and the short end and the long end, that's really what banks want to see. So I think overall, that will improve the net interest margin. Again, it's an area that I think has been quiet for a while, and we think now is starting to that'll help increase overall profitability. So we feel very sanguine about that.
Okay. JPM has been rock solid, Tom, like every step of the way. Mm-hmm. The chart I think speaks for itself. The moments of kind of regional bank crisis turned out to be to their benefit. When you look at the options, does it reflect positivity, stability? What do you see?
A little bit more stability. You got to remember, going into earnings, a lot of these banks don't have big implied volatility levels just because historically they don't move that much post-earnings. Now, that doesn't mean to say that they're not going to move this time. The option market today priced in about an $8.20 move in the shares either way. That's about 3.5%. So not outsized. The stock's just off all-time highs. It was up 40% last year, so it's had a great run. Expectations pretty bullish on this one going into earnings. So I looked at IV levels where I can create an option strategy that takes advantage of the dispersion between them. So I looked at a call calendar for a bullish type of example here, where if you think the stock's going to go up about that one standard deviation, this type of trade works out well for it. Going out to the February 7th weekly cycle, so 25 days to expiration, I'm going to buy the at the money or slightly in the money 240 strike call, and then against it, I'm going to sell in the January 17th monthly options that expire in just 4 days at the end of the week. You're going to capture the earnings event within there. Sell the 250 call, so a bullish $10 wide call diagonal. That's about 3 weeks in duration on this one. So when you're buying a $10 wide call diagonal, I want to pay less than the width of that diagonal. You're paying roughly about a $6.50 debit for it. That's going to be your risk on it, so you're paying less than the width of it. And you can see here from the risk profile, anything probably above about 243 is going to be profitability on this one. The key reason why it costs less than the width of this call diagonal is because you're buying about a 28% implied volatility on aggregate in those February 7th 240 strike calls, and then selling about a 45% implied volatility in the January 17th 250 strike calls on aggregate in that option series. So that lowers the input price on that. But then you'll have the opportunity 3 times to roll or adjust that short 250 call as you go into expiration. Time decay in your favor because you're short that near-term option on the 250 strike. So if you think this thing's going to go up, maybe that one standard deviation, get close to those all-time highs that we saw in November above 254. This type of trade takes advantage of it with those implied volatility levels and the dispersion between them.
Okay, I like that. A good approach, I think, with the call diagonal for a stock that's been pretty reliable. It's also had a good run, though, too.
Yeah.
So you kind of appreciate that by selling the 250 as well. Phil, when you think about the possibilities for banks, I mean, do you see this as a group that can lead the market if we're going to be under pressure like we have been these last couple weeks?
I do. I mean, obviously, if we have an economic collapse, then obviously they will perform. They will underperform. I don't believe that to be true. I do believe that this volatility we're seeing in markets is a lot of it's due to the 10-year starting to move close to 5%. I think that's going to shake up some investors, which is perfectly normal. And by the way, I continue to say this, I welcome normalization of interest rates. It's something that is normal for our economy if you go back the past 100 years, with the 10-year averaging between 4.5 to 5. So if the economy continues to strengthen, which I believe it will, and if interest rates stay where they are, and if they move to 5, I think banks will continue to perform very well.
All right, financials that would be nice to get some leadership from this group. What about if you move down the quality spectrum a bit, Phil? Do you have faith in some of the smaller banks, or is this a game where the winner takes all? Kind of the bigger you go, the safer you are as a trade.
Yeah, the way we invest clients' capital is, we prefer to be more on the conservative side. So, like I said, owning the JPMorgans of the world, the Bank of Americas, we're comfortable owning those businesses. They're large, diversified, they dominate in what they do. So we'd rather not take the risk of some of the smaller banks.
Okay. Bank of America right now, a little change, but a nice run over the last year. Looking at the options for BAC, Tom, as an example. I mean, this is one that obviously is focused on lending as far as the giants go, kind of resembling more of a pure lender in that category. But it's been a great 52 weeks. I mean, they're up 40%, Bank of America, whereas the financials are up 27%. So BAC's done quite well.
Yeah, it's at multi-year highs, but not quite at all-time highs. But, if you take a look at the interest rate environment, the economy doing well, spending still pretty robust, and then everything that Phil mentioned, potential M&A coming down the pipeline, IPOs coming out. I mean, trading pretty robust as far as volumes goes. So that's all a benefit for a lot of these stocks. So I looked at this one a little bit more conservative than the JP Morgan, where I can take advantage of the 2.3% dividend yield on this example
like
trade.
That.
Yeah, so I looked at a cover call strategy. The option market's pricing in about a plus or minus 4% move in the shares, nearly $2 either way. So I used that in my setup on this trade, where for every 100 shares of stock that you buy, went out to the February 7th weekly option, so 25 days to expiration. Just sold the 47 call. That's $2 out of the money to the upside, about that one standard deviation move that the option market is pricing in. You're paying roughly about a $44.40 debit, so you're buying the shares at a discount because you sold a call to the upside against it. So you create yield two ways on this position. You own the shares, so you get to collect that dividend that gets paid out every quarter, and you get to sell an upside call that has higher implied volatility going into earnings. And then as you get closer to expiration in the next 25 days, you'll have that opportunity to roll or adjust that short strike. So creating yield, getting paid to wait type of strategy here with the covered call, but a little bit more conservative. But remember, you own the shares, so it's a little bit more capital intensive, but just trying to take advantage of that dividend yield.
All right, well, fitting, I think, the way Phil described the approach to banks as a whole.
Yeah.
Appreciate that. Thanks for the trades, Tom. Thanks, Phil Palumbo, President and Chief Investment Officer. Good to see you, sir. Thanks for the analysis on the financials. Helpful for us ahead of the earnings season.